like that access to capital that I mentioned before. Oftentimes, smaller companies, they're just a single location in a single market versus these large national players. The management expertise of a large public company, those C-suite executives, they have got robust experience and they're very senior versus, again, that urgent care center down the street might have hired somebody with less years of experience, more green, if you will. And finally, the smaller companies, they're more sensitive to economic movements. There's less cushion in their earnings and in their size to brace against any potential negative events or economic downturn. So really, to put discount rate and return in context, we've got the next two slides that show the first one being realized total returns by asset class throughout history as calculated by Duff and Phelps using Morningstar data. And so I think this shows a really nice linear relationship between, on the left-hand side, the actual return that was experienced, and on the bottom axis, the variation or the volatility of those returns. So you see at the lower left-hand side of the chart, Treasury bills, very low risk, but also low return, up to micro-cap stocks that show a higher volatility of risk, but also investors are compensated with a higher return. So this kind of helps put together what a discount rate means in context. Another study we thought was pretty interesting is one put together by Pepperdine that shows the required return, or again, that discount rate in the private equity space. So just different various levels of funding, all the way up to looking at venture capital and angel investing at the very right-hand side of the chart. These companies, they're starting out, they're in the development stage, they might not even have operations up and running yet, and investors are requiring 35 up to 60% returns to compensate for that risk in that business. So really, we've now talked about the different components used to calculate this risk metric, this discount rate in our income approach valuation. And what we really want to move on to is address the specific types of risk that your valuation specialist should consider, ask questions about, and make sure they're thinking through when performing a valuation, as well as things that you as an attorney can look for in your valuation specialist to make sure they've considered when you're looking at a valuation report. So starting here with our financial risks, we've outlined several points here that we see as key financial risks, i.e., what do the income statements of this entity look like? What does the balance sheet position of this entity look like? And what we're driving here on is, I think Richard mentioned this earlier, the ability of that business to generate sustainable, consistent financial returns for the investor. So I'll just take the first couple, looking at quality and accuracy of financial data. So things that the valuation specialist can look for is, are the financial statements, are they cash or are they accrual basis reported financial statements? And then do we have enough detail in these financials to understand what's happening and what's going on and to understand the business? One point I would like to make on this first, quality and accuracy, your valuation specialist, we're not an auditor, and typically it's not within the scope to perform an audit or a full quality of earnings, quality of revenue analysis. However, there are some sanity checks that we can go through, and we could recommend a quality of earnings analysis, but some things we like to do is look at the big material points on a P&L. Can you reconcile reported revenue to the actual collections that the entity experienced? Can you verify some of the large expense categories like facility rent using the lease? That type of sanity checks and gut checks to make sure that we're getting comfort with the data provided. Then when we look at historical financial performance of the entity, this is a huge risk factor that we see as well. Valuation, Richard mentioned, it's a forward-looking concept. So we are projecting out into the future, but we use these historical financials to inform that future, to help us figure out our projected forecasts and valuation assumptions there. And if there's been heavy fluctuations in performance historically, it's going to be a lot more difficult to get an investor comfortable with our projected numbers, and they're going to view this as a higher risk.
A couple of other items with regard to that. I think one of the things that we as valuers often do with regard to kind of quality and accuracy of financial data, if it's available, is to look at management's historical budgets and then actual performance and how good was management in seeing and estimating the future. If they're pretty accurate about it, then that provides an additional level of comfort. However, sometimes we're dealing with small entities that they may not have a budget. They're going to on a cash basis, and so sometimes that's not available. But that's another aspect that we could look at, is how good is management at predicting its financial future, so to speak. Along the lines of looking at financials, a key piece is looking at fixed versus variable operating expenses, and that is really just what it says, is how much of my expenses are fixed. We see this obviously when we're dealing with hospitals or other pieces along or entities along the brick and mortar side. Obviously there's investment in real estate. Your fixed expenses obviously tend to be more expensive. When you go more toward the physician side, depending upon the nature of that, clearly if I've got imaging or other types of equipment, that's going to be very different than just an x-ray at an urgent care center. So that really gives us a measure of how much do I need to generate to cover my expenses, but it also gives it's a measure of the level of overall financial flexibility. And so even as we're dealing with different aspects or different components of healthcare, we'll naturally have a different level of expected fixed expense. We then need to almost segment the markets that we're dealing with and know that here's a level of fixed expense for this component of the industry. And so the relative benchmark that we have there may very well change based upon the type of entity that we're valuing. The next piece that we want to talk about is the length of operating history. This is a kind of a universal golden rule, if you will, for valuators, is to look at how long has the company been in business and operating. And I think that there's a couple of key pieces with regard to that. Is it indicates the longer an entity operates, it indicates at least an inherent ability or potential inherent ability to weather change, and the fact that they have identified it, overcome it, dealt with it, and continue to move forward. How did they adopt and continue? Did they actually just merely survive the economic challenges, or did they thrive through that? Then the complete reverse to that is also to look at that is to say okay, they did well when they didn't face changes, and so that length of operating history is terrific. The fact that it's been in business for years after years, they've been able to successfully recruit and maintain professionals to continue operations. However, if they haven't had any challenges, those benefits that we just talked about in terms of an operating history may not be present. And so it's really looking at the length of operating history overall as a positive, but we want to look at the challenges. Has it been smooth sailing, and is that necessarily an indicator of when challenges occur that this management team is going to be able to handle those? And we'll certainly talk about a little bit more about challenges with management a little later on in our presentation. Obviously, a key piece here is on historical payer trends. As we started out our conversation looking at that universal equation of value as benefit over risk, payer is top-line revenue coming in the door, right? So that obviously is a major component of any benefit equation or component of benefit that we're looking at. And when we're, for example, it can be a positive or a negative. We saw what happened with Mednax, again, a very timely example, but let's take that to a smaller entity. For example, was valuing a relatively new imaging center in a non-metropolitan market. It was a stand-up MRI, which was new to that region. There was a significant employer in the town. It was a manufacturing facility. Significant economic downturn occurred during that period of time, and the local market was hit with a recession. And what we saw over time was that those